Most Canadians want to pay less tax, but only a tiny percentage actually understand tools available to them. And the interesting part is that these tools aren't secret. They're just buried behind complicated rules, confusing names, and government websites that feel like they were designed in the 90s. Today, we're clearing all that up. In this video, we're walking through 17 legal, practical, and surprisingly simple ways a regular Canadian can reduce taxes and keep more of what they earn. No gimmicks, no loopholes, just smart planning anyone can use. If you want to build wealth smarter this year, hit the like button and subscribe to Bucks and Beyond. Let's get started. For many Canadians, the RRSP is the biggest tax-saving tool they will ever use. The reason is simple. Your contributions reduce your taxable income, often leading to a sizable refund. For 2025, your RRSP limit is 18% of your earned income from last year, up to $32,490. So if you made $120,000, your RRSP room is about $21,600. Unused RRSP room carries forward indefinitely. If you ignored your RRSP for the past 5 years, your room is still waiting for you. You're also allowed a small buffer, a $2,000 overcontribution limit before penalty kicks in. Anything beyond gets charged at 1% per month. For the 2025 tax year, contributions must be made by March 2nd, 2026. For example, let's say someone earns $85,000 and contributes $10,000 into their RRSP. Their taxable income drops to $75,000, which usually means a refund of $2,000 to $3,000 depending on the province. That refund can be then invested again. This is the classic tax-efficient wealth-building loop. And while RRSP helps you lower tax today, our next account helps you avoid taxes forever. The TFSA is one of the most misunderstood accounts in Canada. People confuse it with a savings account, but in reality, it's a tax shelter for your investments. The 2025 TFSA contribution limit is $7,000, and if you were 18 in 2009 and have never contributed, your total room is now over $95,000. The magic is that all growth inside the TFSA stays tax-free. For example, you invest $5,000 into an index fund. Over a few years, it grows to $12,000. When you sell it, that $7,000 gain is completely tax-free. No capital gains tax, no dividend tax. TFSA contributions are based on a calendar year, ending December 31st. Withdrawals don't increase your room until January 1st of the next year. This is why it's smart to plan your TFSA withdrawals near year end if you want the room back right away. Now that we have covered two heavy hitters, let's move into deductions you can apply to your everyday life. Many Canadians don't realize that their employer signs a T2200 form. They can deduct tax expenses related to doing their job. This can include home office expenses, your phone bill, internet, supplies, tools, and even some travel. For example, if your employer expects you to buy a $300 piece of equipment to perform your job, that $300 becomes deductible. There's no special deadline for this, but keep receipts and track expenses during the year so you can claim them at tax time. But the biggest saving often appears when couples coordinate their finances. If one partner earns a lot more than the other, proper income splitting can save thousands of dollars per year. Two main strategies exist here. First is spousal RRSP. The higher earner contributes to the lower earner's RRSP, balancing retirement withdrawals later. The second is prescribed rate loans. The higher earner loans money at CR's official rate to the lower earner, who then invests the funds. The investment income is taxed at the lower earner's rate. RRSP contributions follow the same March 2nd, 2026 deadline for the 2025 tax year. Now, let's focus on families with children, because childcare costs can be a massive deduction. If you pay for childcare so you can work, the government often lets you deduct those costs. Daycare fees, day camps, after-school programs, babysitting, these can all qualify. For example, if your childcare costs were $12,000 last year because both parents work, that amount can significantly reduce your taxable income. Typically, the lower income spouse claims the deduction. This deduction is applied at tax time, but receipts must be from that calendar year. Next, let's talk about education costs, because tuition can be more valuable than people think. If you're paying off government student loans, the interest you pay earns you non-refundable tax credit. For example, if you paid $400 in interest this year, you can get a credit equal to a percentage of that amount. Unused credits can be carried forward for up to 5 years, which gives you flexibility. But the bigger opportunity is with tuition credits, which can last for years. If you or your child is still in school or recently graduated, tuition credit can dramatically lower tax bills for several years. They can be used this year, carried forward indefinitely, or transferred to a spouse, parent, or grandparent. For example, if tuition was $5,000, but you only owe enough tax to use $2,000 worth of credits, the remaining $3,000 stays available for future years. Now, let's move to one of the most powerful tax tools for young Canadians looking to buy their first home. The First Home Savings Account combines the tax deduction of an RRSP with the tax-free withdrawals of a TFSA. You can contribute up to $8,000 per year with a lifetime cap of $40,000. For example, if you deposit $8,000 this year, it reduces your taxable income by $8,000 right away. Then later, when you buy a home, you can withdraw it tax-free. HFSA contribution must be made by December 31st of that year. There is no grace period like RRSP. This is one of the few accounts where missing the deadline actually costs you long-term growth. Now let's start with the investments themselves, because where you hold certain types of income matters just as much as what you invest in. Eligible Canadian dividends receive a special tax treatment in taxable accounts. For example, if you earn $1,000 in eligible dividends, the dividend tax credit reduces the amount of tax you owe. For many middle-income Canadians, this tax rate is significantly lower than interest rate income. This is why many long-term investors hold Canadian banks, utilities, telecoms, and pipelines in non-registered accounts for tax efficiency. But taxes don't only show up as dividends. They also show up when you sell investments. Only half of capital gains are taxable. Say you buy an investment for $10,000 and sell it for $15,000. Your gain is $5,000, but only $2,500 is taxable. You can also offset gains by selling losing investments in the same calendar year. And if you donate appreciated shares to charity, you get the tax credit and avoid capital gains entirely. Since capital gains are tied to the calendar year, the deadline is December 31st. Now, let's shift to an area that touches every family at some point: medical expenses. This is one of the most flexible deductions available. It includes prescription, dental work, orthodontics, glasses, hearing aid, medical travel, paternity treatment, and more. You can pick any 12-month period ending in the tax year you're filing for. For example, if your family spent $4,000 on medical costs, you can choose the 12-month window that maximizes your claim. Usually, the low-income spouse should claim these expenses for the best result. Next is deduction that many people overlook until it's too late. If you move at least 40 kilometers closer to work or school, many moving costs can be deductible. This includes movers, transportation, storage, legal fees, and temporary accommodations. For example, a $3,000 move to a new job could offset $3,000 of your earned income. This is claimed at tax time, but receipts must be from that calendar year. Now let's look at a benefit that directly helps working Canadians with lower incomes. The Canada Workers Benefit is a refundable tax credit. That means it goes straight into your pocket. For example, someone earning around $26,000 per year may receive $1,000 in benefits. This credit is applied when you file, and the advanced payments can be set up automatically. If you donate, there's a way to be generous while keeping more of your money. Donating cash can earn you charitable tax credit, but donating shares is where the real savings happen. For example, you donate $1,000 worth of stock you purchased years ago. You get the full donation credit, and you skip paying capital gains tax on the growth. Donation receipts must be dated by December 31st to count for that year. Now, let's talk about a strategy that helps side hustlers and self-employed Canadians. If you run a business, many expenses are deductible. Phone bills, internet, equipment, software, office supplies, mileage, even part of your home office can all reduce your taxable business income. For example, you drive 3,000 kilometers for business. Using the CRA mileage rate, that could translate into hundreds of dollars in deductions. Record keeping is everything here. Once you retire, you get access to another major tax optimization strategy. This helps retired couples reduce their tax load by allocating some of higher earners' pension income to the lower earner. For example, if one spouse earns $40,000 from a pension and the other earns $10,000, they can split the income so both report $25,000. That kind of balance usually reduces the total tax bill very meaningfully. We're almost there. This last one is simple, but surprisingly valuable. Each province offers its own credits and benefits. BC has climate action credits, Ontario has the Trillium benefit, Alberta has family and child benefits. Many of these are income tested, and some are automatically calculated when you file. This is the easiest money to miss because every province works differently. One strategy on its own might save you a little, but when you combine several of them, your tax bill shrinks dramatically and long-term wealth grows a lot faster. If you found this helpful, hit the like button and subscribe to Bucks and Beyond. I cover investing, smart money decisions, and wealth building every week. Thanks for watching, and I'll see you in the next one.